What is accounting? Why do we use accounting? What role does it play in our world? Hi, my name is Vicky. I'm a fourth year student majoring in accounting. Today, I'm going to introduce you to the world of accounting. The definition of accounting you would find in textbooks is this: identifying, recording, and communicating the economic events of an entity to interested users. What does it even mean? Let's break this definition down word by word. Imagine that you own a bookstore and sold books for $500 today. This is a significant economic event. After we identify this economic event, we need to record it. You would enter a journal entry in your company's books by debiting cash and crediting sales revenue. Cash and sales revenue are two different accounts. Think of an account as a seesaw. Debit is on the left side and credit is on the right side. Think of the numbers in the account as weights. If the left side is heavier than the right side, then it has a debit balance. If the right side is heavier than the left side, it has a credit balance. Now, an important concept to note here is double entry accounting. An economic event always affects two or more accounts, hence the name double entry. Here, as you can see, selling books affects the cash account and the sales revenue account. Let's familiarize this concept with another scenario. Pretend your bookstore bought a $200 bookshelf. What journal entry will you enter now? You would debit equipment, your bookshelf, and credit cash, the money you paid for $200. This economic event affects two accounts, cash and equipment, and it further solidifies the double entry accounting concept. Finally, with all the recorded economic events, you, the bookstore owner, can communicate the information to interested parties using financial statements. There are three main types of financial statements: the income statement, the balance sheet, and the statement of cash flows. Let's briefly look at what each one does. First, the income statement. Think of the name income. How does a company generate income? You're right, from revenues and expenses. So it's only reasonable that the income statement includes revenues and expenses and results in net income or loss. Next, the balance sheet. What does it balance? Assets and equity plus liabilities must be balanced. The balance sheet is a snapshot of a company's financial condition. It tells us how much assets, liabilities, and equity a company has at a point in time. If you are not sure what assets, liabilities, and equity are, don't worry, I'll explain later in the video. Finally, the statement of cash flows. Where does the cash flow? The statement of cash flows tells you how much cash flows in and out of the company over a period of time. It includes information on how much cash was received and used for a company's operating, investing, and financing activities. The operating section is derived from the income statement. The investing section is related to non-current assets, and the financing activities include the company's funding. The statement of cash flows is important because, for a company, cash is as vital as blood to humans. It is essential for operations. Also, notice how the income statement and the statement of cash flows are for a period of time, whereas the balance sheet is for a point in time. So, why do we need to communicate financial reports to users? Who uses them? Well, there are two types of users: internal and external users. Internal users are those inside the company. They use managerial accounting and cost accounting. Cost accounting relates to calculating cost, and managerial accounting uses the information accumulated from cost accounting to make management decisions. For example, human resources use accounting data to know if they can pay their employees. Management looks at accounting reports to know which product line is the most profitable. How about external users? External users include investors and creditors. Investors use financial statements information to decide the stock price to buy or sell. Creditors might use the information to see if the company will be able to pay the debts they owe. Without the three activities of identifying, recording, and communicating economic events, companies won't be able to function. People might not get paid. And as the business world falters, so does our economy and our everyday lives. Is accounting important? As it turns out, very, very important. If accounting is so important, there must be a rule, a regulation, or a standard we must follow, right? Yes, right now the world has two major standards: the International Financial Reporting Standards, short for the IFRS, and the Generally Accepted Accounting Principles, also known as the GAAP. The IFRS is issued by the International Accounting Standards Board, and the GAAP is issued by the Financial Accounting Standards Board. The US follows GAAP, and the rest of the world mostly follows IFRS. To increase comparability between the two reporting standards, the two boards have and continue to make efforts to converge the two standards. Finally, let's look at one more concept of accounting. This is the backbone of accounting. This is what holds accounting together. This is what you've been waiting for: the accounting equation. Assets equal liabilities plus equity. What are assets? Well, assets are what a company has. To be more specific, assets can provide future services or benefits. For example, the assets of your bookstore company include cash, equipment, and books as inventory. These three assets provide different types of future benefits. Cash is for exchange, equipment is for use, and inventory is for sale. If you remember, earlier in the video, I presented the balance sheet. Inside the balance sheet, there's an asset section. Assets can be grouped into non-current and current assets. Non-current assets are long-term assets including equipment, land, and buildings. Current assets are short-term assets including inventory, accounts receivable, and cash. How about liabilities? Liabilities are what a company owes. They are existing debts and obligations. For instance, in your bookstore, the money you borrow from a bank to open the business is a liability. The money you haven't paid for buying the equipment is another liability, usually called accounts payable. Just like non-current and current assets, liabilities can be grouped into non-current and current liabilities. Non-current liabilities are debts and obligations for over 1 year. For example, notes payable. Current liabilities are those less than a year. For example, accounts payable. Lastly, equity. It is the last one introduced for a reason. Another term for equity is residual equity. Think of equity as leftover. We use assets to pay our liabilities first, and whatever is left of assets minus liabilities belongs to equity. It is the ownership claim on a company's assets. For example, in a corporation, you might get funding from investors. The shares you issue in exchange for the cash received are considered a type of equity. They are called share capital. Another type of equity is retained earnings. As the name suggests, earnings retained over time are retained earnings. It is a company's revenues minus expenses minus the dividends paid to its shareholders. Okay, we have learned a lot, so let's review and see if you can remember them. What is accounting? Accounting is identifying, recording, and communicating the economic events of an entity to interested users. What are the three financial statements? First is the income statement, how much profit a company earns over time. Then the balance sheet, a snapshot of a company's financial condition. Finally, the statement of cash flows, the in and out of cash in the company over a period of time. Because accounting information is used by all kinds of internal and external users, there are standards we must follow in the accounting world. The US uses GAAP developed by FASB, and the rest of the world uses IFRS developed by IASB. Last but definitely not least, the most important equation. Do you remember it? Assets, the resources a company owns, equals liabilities, obligations to third parties, plus equity, also known as residual equity, which is whatever is left of assets minus liabilities. Now, you might be curious, what can I do with an accounting course? Will it help me in the future? The answer is a big yes. Accounting is the language of business. You can use it to make business and investment decisions. It's a skill that helps you regardless of which path you choose in the future. That's it. I've covered some of the most important concepts of accounting. Besides these concepts, all you need to successfully master accounting are basic arithmetic skills, a good sense of logic, and attention to detail. Great work and a big thank you for following along. With all the newly acquired knowledge, I believe you are well equipped to start your accounting adventure now. Have fun!